We said the first method is what? The forward rate what? Agreement. Is that? And we looked at this in our last class, even though we didn't really go so much on it. All right. So forward rate is just like we have forward rate also in currency. All we are saying is that the interest rate to be used in the future is determined from when? From now. And so by the time you do that, that means you have to do what you have tactically locked in that interest rate from today, right? Okay. And again, don't forget that this is also an what? Over the counter. Can we remember what over the counter means? All forward, they are over the counter. All swap are also what? Over the counter. Then you see exchange traded option, you see futures. They are what? They are exchange traded option. Options are futures. They are all exchange traded. Please, do you understand? Over the counter, you have forward, you have swap. Exchange traded, you have options, and you have what? Futures. And I try to explain the difference between the two of them and also the advantages and disadvantages of those two. All right. So in forward rate agreement, what are the things I need to know? Number one step. Step one is to identify, Abby, the relevant FRA. Is that not? And we did this in our last class. And I said in the exam, your FRAs are quoted as A versus what? AB, Abby. Where A equals to time from when? Now. From now to when? To transaction date. Transaction date. What is my B? Okay, so you know I gave you two, right? There's one that's A versus B, Abby. This one is saying from now to what? To end, Abby. End of the futures, Abby. Or end of the end of the transaction. If you are using A plus B, this is B is simply the tenor of what? Of the loan. So that A plus B will now be what? Time from now. Yes, time from now up to the end. I don't know if you understand what I'm saying. So it all depends on what you're looking at. Either you are looking at A versus B or A versus AB, right? They are saying the same thing. I'll show us now. So that's the first step. If I have today to be 31st March 2025, and then I want to take a loan time, when I want to take the loan, which is my transaction date. Transaction date is 31st May 2025. Loan tenor is 4 months. 4 months. What is the relevant FRA, guys? What is the relevant FRA quote? What should it be? FRA. Six. Eh? Online, what is it? What is relevant FRA?
2 versus 6.
2 versus
2 versus 6.
2 to 4, 2 to 5, sir.
2 versus
2 versus 6.
What you are saying is correct, but in the exam, see what you are doing here. 2 versus 6, yes. Abi? Yes. This one that is here, this opposite here, is time from now till the end, Abi. So you can decide to break it to say time from now to transaction date, then time from transaction date till the end of that loan, which is still the same thing. Are we all clear? Are you good? You know why you are lost? Okay. 2 versus 6 is correct. All right. So just one more and then we'll go into the next step. Today is 1st January 2025. Transaction date. Transaction days is 31st March 2025. Loan will be paid in 7 months. What is the relevant FRA?
3 versus 7.
3 versus 7. Okay, were you in the last class?
Yes.
Are you sure? Okay. The correct one is 3 versus 7. 3 versus 7. Loan will be paid when? In 7 months. In 7 months means they are starting from today. So that means that AB is what they have given to you already. In the exam, sir, you will see 3 versus 7 and you see 3 versus 10. You got it correctly. Oh. Okay. But you're asking a question. Okay, so the last one here, this AB, is time from now till the end of that loan. And they said they are paid. The time from now till the end of the loan is actually the whole thing now, from now till the end, which is what they have given to you. They say the loan will be paid in 7 months. That means from today to 7 months. That's when they'll pay the loan, which means that the entire period has been covered, which is the A plus B. Which one? The first one. Because the first one, they just gave me the tenor of the loan. Tenor of the loan is starting from when you took that loan to the end of the loan. Yes. So they are not the same. The other one is counting from today. The second one is counting from the tenor of the loan. All right. Okay. So the next step, after determining the relevant FRA, the next step is to determine the effective rate. Effective rate is practically the same thing as lock-in rate. Lock-in rate. This is what to be used to calculate the interest, just like we have in currency. You know, in currency is convertible. This one is to calculate the interest on the loan or what? Or investment. And then our effective quote, how do we calculate? Effective rate equals to FRA plus company's borrowing capacity. Or let me put company capacity. This is step 2. Step number 3, use the effective rate to calculate the interest on the loan. Please, who has the combined part finder? Anybody? Okay, let me look at, I think. March, July 2020, question 2. March, July 2020, question 2. Question 2. Let me see. Please, I just sent it to us now. Are we all there? Is it not clear? Who doesn't have it yet? Online, do you have it now? Online, do you have the question? It's not clear.
It's clear. We have it, sir.
Yes. All right. So let's look at it. Say again. No. Why? Why are you asking? You want to avoid it. You see them? See them. You're already doing calculation. That's cherry picking. Eh?
And the unfunny questions that are not like this. It's just like
No, you can't see it, number one. At least in ICAN, no, you won't see it. But you can see it in either B or C, any other place. But ACCA, yes, 50 marks. In fact, this is one of their area, their strengths, because the students are running away from it. So when I wrote ACCA, it was my number one, and I was so happy. Within 30 minutes, I was done with the whole 50-mark question. If you know it is cheap, right? But if you don't know it, you don't know it.
the question is 50 marks.
Yes, too. There are question one.
What's the pass mark?
Eh?
What's the pass mark?
Is that 20? No, it's not average. 50. 50 is 50. Yeah.
So
It's the CFA that is average.
They're going to get 15. That question one, that's fast.
No. If you can get everything, why not? Now you are passed now. Question one is 50. If you don't know it, that's the end. Okay, so I'm reading. Okay, Mr. Bigat. Mr. Bigat is a Nigerian highly successful businessman with interest in manufacturing, transportation, telecom, and aviation. He has recently shown interest in acquiring one of the La Liga League football club in Spain. Negotiation, they don't want to call his name, is Dangote actually. Dangote wanted to buy a football club one time, Arsenal. And not be La Liga, but they just change it so that they don't go know. But they are referring to him. You know, ICAN, they do research a lot. So, okay. Negotiation with the current owners of the club is now completed and price agreed. Mr. Bigat's group of companies have been able to raise a significant portion of the total amount needed for the purchase consideration of the club. But there's a shortfall of $150 million. Today, what is today's date? September 16, 2020. So there's a shortfall. What are they referring to? Is it an investment or is it a loan? It's a loan. They want to buy something, Abi. They raise something, and then there's a shortfall, right? That's a loan, Abi. So we have our exposure already, and it's what borrowing. Thank you. All right. Where are we?
And the total payment.
That's loan. I want to take loan now. Yes, we want to take loan in the future, right? That's what it means. Okay. Okay. Shortfall of 150. Today is 16 September 2020. And the total payment for the acquisition must be made by December 16, 2020. December 16 is what kind of thing is that? What is it? Today's date? Is it transaction date? Is it the future period? Is it the forward period? That's our transaction date. That's when they're supposed to make that payment. So we have our today, we have our transaction date. Sharp. A 2-month loan of 150 million commencing from when? December 16, 2020 is therefore being considered. What is the tenor of the loan? 2 months. 2 months. Now, from this information, tell me what is the relevant FRA. Now, if you go down after the first table, the second table, then you see FRA prices. Can we see that? Can we see FRA prices under the last table? Now, what did you tell?
2 months.
The question told me the loan will be for 2 months. It's not, it's there now. Yes. Yeah. So the FRA prices, we have 3 versus 6, 3 versus 5, 3 versus 8. Now, from what information we have now, tell me, what is the relevant FRA?
3 versus 5. 3 versus
5. So it means the relevant FRA
Yes.
to me here is 7.08 to 7. Is that not? Yes. And again, I have a bid.
Yes.
And then what? And the offer. So I have investment and borrowing. So which of these quotes or rates am I going to be using for investment? I don't know if you understand. In currency, we have bid and offer, whether you're selling or buying currency. In interest also, we have bid and offer, which is borrowing or investment. So which one are we going to be using for this borrowing case?
Bid.
Is it the 7.08 or 7.00?
7.08.
7.08. We are using the 7.08.
7.08. And if you want to take loan, the bank will charge you what? Higher. If you want to invest, the bank will charge you which one? Maybe interest on the lower rate. So that means we have information relating to our FRA. So let's quickly deal with this. And then we go into the futures. Forward rate agreement. What is our exposure?
$150 million.
Right? We have tenor. What's the tenor of the loan? Don't forget, this is loan. Let me write it. Tenor of loan. How many months? 2 months. No, they will definitely tell you the tenor. They will definitely, if they don't give you tenor, they will tell you the loan is meant to be paid in 3 months. So they will definitely tell you. Yeah. Tenor of the loan, 2 months. What else? Today's date. September 2021. 2020. Transaction date. Transaction date. 16th December 2020. And then let me start picking my mark. I will just say relevant FRA. No thinking. Relevant FRA. We have what? 7.08. There's no need again. Is that not what I need? There's no need to start writing to 7 again. Prayer time?
No.
Okay. All right. Okay. So the next thing is when I get this already, I don't have a problem. All I need to do is to calculate my what? Effective rate. An effective rate is simply my FRA plus what? Yeah, company's capacity. Now, let me explain this capacity. This capacity is also known as the floating capacity. Now, what do I mean? You see questions where they will say the company can borrow at 90% basis points below or invest at 30% due to the capacity. The only thing that is common to 2 of us is this FRA, because if you get to this market, the FRA will be quoted for us. But our capacity is different. If you go to the bank today to borrow money, and Dangote also goes to the bank to borrow money, who would likely get cheaper rates than the bank? So it's because of what? The risk, the capacity, the earnings, and all of that. So now, this company's capacity is your floating. What is floating on your FRA or on your NIBOR? What you are actually hedging against is this one. You don't hedge against this one because this one is determined by your business model. If your business is doing well, this one will be advantageous to you, depending on whether you are borrowing or you are investing. Some persons want to invest money now, they can give them as much as 19%, 20%, just normal investment. But if you carry your checked money there, they will tell you that the interest rate for the investment is 4%. And why are they doing that? Because of the capacity. So all we are doing in FRA is simple. The moment you identify this FRA, which is going to be gotten from determining the relevant quote, in front of this quote, you see this amount there, right? Choose the right one, then add the company's capacity, which will be given to you. Now let's go to the question and see their capacity. Yes. No. Labor is the rate ruling now. FRA is the rate that we are determining now for future. They are not the same. Labor is the rate now, just like your spot. In interest, labor is the spot. In interest rate, in currency, spot, that's the rate as of now. You understand? All right. So let's go to the question. Now look at the paragraph 3. The group finance director, GFD, has spoken to the bankers in Madrid who have agreed to provide the 150 million needed, giving Mr. B's credit rating. Remember, I told us this capacity is determined by your model, the kind of business you do and who you are, right? And then giving their credit rating, they said the short-term loan will be at the rate of what? 90 basis points above what? Above LIBOR. So now what I'm edging against is actually that LIBOR. Because that's what will move up and down that can affect me. But as far as this capacity is concerned, nothing can change that. Are we together? So, and here, the moment you identify, you just replace this amount, the labor with FRA, which I told you, this one is company capacity, which is how many basis points here? 90. 90. So now we have determined the effective rate. So we just do our effective rate becomes 7.08, Abi? 7.08% plus the capacity is how much? 90 basis points, same thing as 0.9%, Abi? 0.9%. Help me.
7.98%.
7.98%. This is my effective rate. Yes, please.
Please, I'm not following. No, you are showing them things, and we are online now. You are saying, I don't know how the 0.9% comes about, please.
Okay, is it the question now? 0.9, is it not correct? Look at paragraph 3. The finance director has spoken to the blah, 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 and they said the short-term loan will be given at the rate of 90 basis points above LIBOR. Can you see that? That 90 basis point is what you call the company's what? Specific capacity. The moment you identify your relevant FRA, just replace, put the FRA quote, and then add that capacity. That's all. That gives you your effective rate, or what you call the lock-in rate.
Okay, thank you.
Are we good? Any other question? Any issue? Okay. So the moment we get this, we are almost done. Now, a short approach that we'll do here is, I would say, effective interest payment, Abi, because it's a loan and paying interest. We now be 7.98% multiplied by how much is the loan amount? 150 million.
150.
Multiplied by what? How many months? 2 over
months.
12.
2 over
I'm
12.
done. Help me. How much is this?
1995. 1995.
1995. Like this, Abi?
Yes.
Million. Like this?
Yes. Yes, sir.
Any issue? Tell me. Where we got the 0.9? Capacity now. Do you have the question? Read paragraph 3. Oh, I see. Have you seen it? Paragraph 3. 90 basis points, yes. Prayer time. Okay. So you can go for prayer. If you have question, while we wait for them, please ask your question. Ask your question. Ask your question.
Mr. Chris.
Mr. Chris, sorry, I joined the class late, and I understand that we pick the relevant FRA based on the date provided, September to December,
Yes.
and all that. But it's not really clear in my head why we chose 3 to 5, because my calculation is not giving me that.
Okay, what's
I
your
want
calculation? Tell me. Tell me your calculation.
So I'm checking September to December, but then the extra 2 months, if I add it, it's not giving me 5. I don't know where 5 came in from.
You are checking what to when?
So they said today's date being September, and that the total payments, which I assume is the transaction date, December 16th.
Hold on, today. Hold on now. Today is what? September what?
16th.
16 September. What's the transaction date?
December 16th. The question.
16 December. Right? What's the tenor of the loan?
That's from 16th.
What's the tenor
from
of the
September
loan?
to December, right? That's
Hold
like
on. What is the tenor of the loan? The examiner told you the tenor of the loan.
The tenor of the loan is 2 months.
Okay, yeah, it's 2 months. A 2 months loan. Yes,
2
it's
months.
2 months.
2-month loan. So remember your relevant FRA. I said it's quoted as A versus AB. Abi?
Yes,
A
sir.
is the time from now till transaction date. B is
Okay.
tenor of the loan. Abi? So time
sir.
from now to transaction date is from this 16 September to December. How many months is that?
That's not
16
4
September
months.
to December. Count now, count your finger. I'm waiting.
Okay, it's 3 months.
3 months, Abi. So I have my A already. I'll say A, which is 3 versus, I have A already, which is 3 plus,
Yes,
what is the B? B is the tenor of the
Okay.
loan, Abi. Tenor of the loan
Yes,
is
sir.
2.
Yes.
So this is 3 versus 5.
5.
That's all.
Thank you.
Yes.
Mr. Chris. Hello?
Yeah, 2. Yeah, because this quote, yes, hold on, please. This is per annum now, of course. This is 2/12, yes, to get the value in months. You are 5/12, of course. Exactly. You are smart. Very smart. Yes. Yes, online, what's your question?
Okay, I just want to know if contract forward and the forward rate agreement are the same.
They are the same. One and
Okay.
the same. All OTC. Same father, same mother, same grandparents.
Okay,
Which
thank
one?
you.
That question has all of them. The question has forward, has option, has features. When we are done with this FRA now, we'll go into feature. From feature, we'll move to options. Eh? Wait, what do you mean? This is the engine now. This is the engine now. Uh-huh. Exposure, yes. Mm-hmm. No, wait. Is this your quote?
Yes.
Your exposure, uncle. Your exposure is in which currency? Are you sure? Uh-huh. So if dollar will not go now. If you multiply, this is pound over dollar multiply by pound, Abi?
So multiply by dollars. So that
Hold on now. Is this your exposure?
Yes.
Is this your exposure currency?
Yes.
So that means it's division you are doing now. Uh-huh. No. How? See now, is inverse you are doing here now? Is it not inverse? This is 0.0355 now. By the time you do 1 all over, you have done inverse already. That's why you switch this quote. So the moment you switch this quote, of course, you swap instead of this 0.355, you bring it, you make it 1 over 0.3. So you have done the inverse already. So the currencies also change position. That's why. So it's division. Yeah. Yes. If you have 2 exposure in the same period, you net off. We'll see that in another question. You do a net off. If they are in the same period, let's say this one now is paying. So when is it paying? This December 16, Abi? December 16. Let's say there's another receipt from maybe foreign currency. The same period, just do a net off, right? Provided that they are in the same period. If you are dealing with currency, provided that they are in the same currency. Does that make sense? You have to do them, no, you have to do them separately. So they will have given you 2 quotes. Yes. Yeah. Thanks, man. Basis period. You know, we are starting from 16th September, right? 16th September to 16th October, 1. 16th October to 16th November. 16th November to 16th December. If you are in doubt, that's it. That's it. That's it. If you get to future, you see why it will be dangerous to do that. Because of your unexpired basis. You know, your futures will expire at the end of December, Abi? 31st December. So if you are counting it that way, you assume that it's 3 months. Meanwhile, it's not 3 months, it's more than 3 months. Because your future is going to be expiring at the end. And I'm sure that's why they did this 16th thing. They don't need to tell you your futures expire on the last day of every month. Is that not? So if you have December futures expiring on 31st. Those that have been supporting my channels, or my channel rather, thank you very much.
Mr. Christmas, I don't know how to see live comments in that distance. I don't know if it's because I'm using a phone to watch it. Or it's not giving me option for live chats.
Investment appraiser.
So I was there. I was still there. I did not check the group. I didn't went to go and meet another place.
Oh, really?
I was still waiting.
No, I don't know what happened to YouTube. Oh, sorry.
I did not know that.
I think
and now saw somebody that was in the class.
Oh.
Saying, you better continue. Say yes.
Sorry, I don't know what happened to
Christy,
YouTube
scroll
that
up
day.
the board, please. I'm trying to copy. It's okay.
Hello, Mr. Chris.
Yes, please.
This question: when they said a company borrows at a variable rate, interest rate, can you help me explain what it means? Does it mean that the interest rate can either go up or down? Why would a company borrow at a variable interest rate? I don't understand.
Okay, so now the concept you're explaining is under interest rate swap. All right, so when you talk about interest rate swap, you're simply just looking at a situation whereby a company, when you operate in a country that has volatility. Like Nigeria, for instance, it's better for me to have a fixed interest rate rather than variable because the variable rate is just changing every now and then. So the risk is higher for me. You understand? So when they say a company can borrow at variable rate, it means that variable rate is the one that's changing. That's the one that you have your LIBOR plus whatever basis point. So the LIBOR is constant as yes, plus your capacity. That's the variable rate. LIBOR plus whatever capacity. Yes.
So that means that they don't have fixed interest rate. They only have variable interest rate. Good.
Okay, so now there are two things here. In terms of having whether it's fixed or variable, in the exam they will tell you the first scenario is that they will tell you that both parties have right to either borrow at a variable rate or borrow at fixed rate. So what you do if you're trying to get swap is to ascertain which one is good for the two parties, right? Looking at the one that is cheap for two of them. Another scenario is when they tell you specifically that this company can borrow at variable rate, automatically the counterparty must be willing to borrow at fixed rate. So you now do a swap for them. Do you understand? But when they say that two of them can borrow at both rates, it means you have to determine which one is actually more profitable for the two of them. Right? And we'll do something like that when we get to interest rate swap. No thinking.
But I'm thinking it's just a thought. Why
Yes.
trying to borrow from within a variable interest rate? Is it not risky? Is it not better for one to stick with fixed and not kind of enter into a risk investment that will either go higher than it's supposed to be?
Now that is the essence of the swap. The person that is willing to take the fixed rate means that his own economy, where he's borrowing money from, is very volatile. And what he's looking for is a fixed rate. The person that wants a variable rate is where a company where the economy is relatively stable. If the economy is relatively stable, it means that it's better for me to actually borrow at LIBOR plus whatever capacity that I have, right? Instead of borrowing at a fixed rate that's high. I don't know if you get what I mean. Yes.
Yes, I do. Thank you.
Yeah.
Thank you.
Yes.
Yeah. Please, can you explain issues in capital international investment appraisal?
You're not in that class.
There's something that is not that clear.
Like which one? Some things. So what are those things that are not clear? Number one issue is the conversion rate, Nabi. The conversion rate. So that means you have to predict the forward rate using your purchasing power parity or interest rate parity, depending on which one is given to you. Good. The next one is repatriation issues. Repatriation issues or restriction means that where a foreign country is putting a restriction on your cash flow. Let's say that you have investment in UK. And when you're done with all the cash flows, UK government now say that out of these cash flows you have made, you can only transfer 50% of that cash flow. It means that the actual cash flow you are going to be converting, right, into Nigeria currency is simply that 50%. That's the other one. The next one is what? Tax issue. When you talk of taxation, we are simply just saying that where you have taxation treaties, right? If you suffer too much in the foreign country, you're not paying any extra in Nigeria, for instance. Is that not? So if the tax rate in UK is 40% and tax rate in Nigeria is 30%, are you paying any extra cash, any extra tax? No, because UK already charge you 40%. So if you have 30% in UK, 30% in Nigeria, are you paying extra? No, because it's same thing, Abi. But difference of which one? UK is 40 and Nigeria is 30. Who are you paying it to? At how much? At 40%. So you want to pay additional. How would they not tax it in UK? Shey they whine me. The difference only when the tax rate in UK is like 20%. The one in Nigeria is 30%.
Yes.
That means you pay less than what you're supposed to pay. So the differential, you pay it in Nigeria by converting the before tax cash flow to Nigeria currency and then charge the extra and then bring it as cash outflow. Which other one again? Which other one? Is it payment, royalty? That's on a royalty and maybe raw materials that you're using from Nigeria. I'm not sure. Which theory? What is it? Portfolio theory. They've not communicated. I'm not sure yet, really.
Intensive, I mean.
Even the class, I'm not sure yet. Let's see how it goes. Let's see how it goes. We'll communicate this night. This night I will communicate. Black school. Are we back from prayers?
Yes.
Oh, okay. Online, can we continue? We'll talk about it.
So if they are paying, they don't back now. Now 1,995.
Interest. What you're hedging against is interest, now, is it not? Is interest you're hedging against. The interest, the amount you're paying as interest is what you're looking at. Does that make sense? This is the interest. Now, when a question is not asking you to demonstrate under this FRA, now I will teach you the two. If the question says demonstrate how FRA will be used to hedge, right? The impact of changes in labor, blah, blah, blah. There's a way you do it. If the question is just asking you to advise them on what to do, by the time you get to this point, what I will just do is regardless of the changes in labor, the FRA is locked at what rate? 7.98%, giving an effective interest payment of how much? 1,995,000. Is it not? Because it's actually locked in already. Are we good? Changes in labor. Yes. Locked in. When you say locked in, it's just the same way we had currency now. In currency, we have something like locking rate, Abi. When you say you are locking in a rate, it's like you are locking it now. Same literal meaning, right? You can't vary it again. We have agreed and we have agreed. It's locked. The transaction is locked. So what we are saying under FRA is that from today, we have determined that the quote we are going to be using is how much? 7.98. So whether interest rate is moving to heaven or hell, will anything happen to how much I'm going to be paying? No. So when a question is asking you to just advise the company on what to do, all I'm just doing is when I'm done with this calculation, and this calculation is simple. FRA plus what? Company's capacity. Use that to convert, to calculate the interest, which is this amount. And then I'll come and drop these 2 or 3 lines. Regardless of the changes in the labor, the FRA is locked in at what? 7.98. Giving what? An effective payment of this. So whether interest rate is going up or down, it doesn't affect this amount I'm going to pay. But assuming that the person asked me to demonstrate, now let's do that.
Sir, please, why is the currency changing? We moved from dollar to naira.
Where is Naira? Oh, sorry. I beg go, sorry. Interest rate, you don't have that problem. You don't have to deal with. This is interest rate. Sorry. No vex. I was testing you. Okay. If the question requires students to show how FRA works, the below extra steps. Yes. Okay. Oh. All right. Now, if you go to the question, let me show us something. Okay, now can we see? They said currently labor is at what price? At what rate? Look at third paragraph, line 4. Currently labor is at what? 6%. The bank has also suggested that due to the current economic uncertainty, labor may do what? Rise by 1% or fall by what? 0.5 over the coming month. Right? Now we want to demonstrate. Now look at what I will do. Very simple technique, no thinking. Now I will come here and say labor increase by, the first one is 1%, Abi. And I'll come here and say labor reduce, Abi. Labor decrease by 0.5%, Abi. Now, if labor is increasing by 1%, what it simply means is that my current labor is how much? 6, Abi, plus 1, Abi. So that means I'll be having 6 plus 1%, Abi, which is 7%. If labor is reducing by 0.5, meaning 6 minus what? 0.5, which is how much? 5.5%. I'm picking my max, right? So the next thing is now to calculate my actual payment. Current labor. Have you seen it? Current labor is currently 6%. Have you seen that? Now, actual payment. Now, let me explain. When you work, sorry, what you should tell me? Have you seen the labor? You don't like materials on fold. Oh, sorry. Now, what was I about to say? No, we started now. Now, I've told us, if the question asks you to advise, where are you stopping? Draw this line. If they ask you to demonstrate, that's when you're doing this one. They want to see whether you know how to actually set up hedging, FRA hedging. And that's what we are doing now. If they don't ask you to demonstrate, guys, there's no need. Because either ways, you get the same thing, the same answer. And I'm going to show you now. Now, when there's an FRA hedge, now let me explain to you. You have gone to Aboki. Let's say that you and I want to agree on something, right? And we have said that you are the bank and you are the counterparty and the company that wants to hedge. Then we have this guy as the bank, right? Two of us will go to the bank and will say, look, we have this amount. This person is like the middle person. I mean, you and I have agreed that at the end of 3 months, this is, or 2 months, this is how much you are going to be agreeing to be paid. We locked in that rate. At the end of the 3 months, if exchange rate is going up or down, how much am I going to be paying to you? This same amount. So it simply means that because this bank is involved, the actual amount they are going to be debiting me is going to be based on the actual movement. If the bond increases, now look at, let's put the figure to it. This guy, actual payment here will be 7%, 7% plus his capacity is how much? 0.9, Abi. So that means the bank will debit the person 7.9% actual, because that is the closing. The agreement we had, this bank will just directly just debit me. Is that not? Because that is the closing rate at the end of the period. So now this guy will be 7.9% multiplied by 150 million multiplied by 2/12. That's how much they are debiting. How much is it? 1? No, it can't be it now. 1,975,000, Abi. Now look at, I will just come down here very smartly. Effective payment. At the end of everything, how much am I going to be paying? 1.99, right? 1 million. I'll just come and put this one here. 1,995,000, Abi. 1,995,000. This one also, how much am I paying? 1,995,000. This is how much I'm going to be paying eventually. Now look at this first scenario. How much did the bank debit me? They debited me 1,975. What did I agree that I'm going to be paid? There's a differential, Abi. The difference between this guy and this guy, what will happen? Is it a payment or a receipt? I promise I'm going to be paying 1.995. The bank debited me 1.975 actual. This difference, am I paying to the counterparty or I'm receiving? I said I'm going to pay this amount. We have locked in that transaction. Yes. At the end of the period, this is how much the bank debited me. I checked my bank statement and this is the debit I'm seeing.
You are paying, sir. You are paying 20. You are paying 20,000.
Because I already agreed that this is how much I'm going to be paid. Yes. There's nothing like bonus. So that means this difference is what? Help me compute the difference.
20,000.
20. So 20,000. They will call this one payment to what? To FRA. And this payment to FRA is simply the difference between what we agree. Look at my lock-in is how much? 7.98, Abi. So if I have 7.98% minus 7.9%, right? Multiply by 150 million, multiply 2/12. It will give you the same thing. Sharp. Okay. So if you agree something, right, with the bank and you lock in that rate with the person that is borrowing you money, at the end of the day, the only thing that the bank is doing is the bank is debiting you based on the movement in labor, in the market. So when at the end of the day, if the bank now debits me, right, I will now go back to the person that we agreed together and say, oh boy, or in fact, I will not even go. It's the person that will come and meet me and say that the bank debited you and gave me only 1.975 from your account. But we agreed that you are going to pay me how much? 1,995. The difference, I will now pay it to him. To the person now, which is the payment to FRA. Right? So now the second one, actual payment. How much will that be? Actual payment, I should have, this is 5.5 plus what? 0.9, Abi? And that should give me how much? 6.4%. Is that correct? 6.4%. And so my actual payment here, payment will be 6.4% multiplied by what? 150 million multiplied 2/12, right? Help me. How much is this?
1.6 million. 1.6.
1,000,006. Like this, Abi. Now,
Yes.
what is happening here? The difference is how much? 395,000.
395.
95. So this one will be what? Is it payment to FRA or receipt from FRA?
Payment to FRA.
Payment to
Payment
FRA.
to FRA.
If this were to be received now, you know the interpretation will change, Abi. I agree that I'm going to be receiving this one and all that. I don't know if you get what I'm saying. So this will be what? Payment. Payment to FRA. And this payment to FRA is simply the difference between this guy and our locking, Abi. So which is 7.98, Abi. Minus what? 6.4%. Then multiply by 150 million, multiply by 2/12. It should give us this guy, 395. That's all about FRA. No thinking at all.
Interest.
Interest, yes. Eh? Okay, so like I said, if they don't ask you to do demonstration, you don't have to, right? Where do you stop? Just stop here. Because what has happened here is, with all this demonstration, at the end of the day, how much are you paying? Is this guy in Abi? At the end, you still pay 1.995, which is your locking rate at the end. Eh? 6.4% multiply 150 multiply 2/12. All right.